Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Hey everyone, welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. First question is from Jonathan. Now he says, I don't think the Trump administration is really going to mess with Social Security benefits and benefits for older folks. But do you think they will change ultimately how the benefits are taxed? All right, Jonathan, let's take a minute and let's explore how benefits are taxed right now with Social Security. And it's a pretty low income amount. So there's something called a provisional income, which is actually a term in the IRS code which takes your adjusted gross income and adds it to half of your Social Security and all of your tax-free municipal bond interest. So even though the municipal bond interest in and of itself may be tax-free, it gets added into this equation. And if that number exceeds $25,000 for single taxpayers, $32,000 for married taxpayers, then part of your Social Security benefits are taxed. Up to as much as 85% of your Social Security gets taxed. So if you think about it, if your Social Security benefits are $2,000 a month, half of that is $12,000, which means if you're single, you can only have another $13,000 of income before that Social Security starts to become taxed. Again, as much as 85% of the benefit can be taxed, at the high end. Now, it doesn't mean that they're gonna take 85% in tax. Right? It doesn't mean you get a dollar from Social Security and most of it goes to the government. That's not what it means. But it does mean that 85% of your benefit might have to be claimed as taxable income on your tax return. So the problem with that, Jonathan, is that a lot of people think the highest tax bracket right now for individuals is 37%. And that's really not true, because for certain retired taxpayers, you might be in a lower tax bracket on paper, but if you're in that window where every dollar that you earn causes $1.50 or $1.85 to be taxable because of Social Security, then you might find yourself in a higher marginal bracket than just the 37%. Now, what's particularly challenging about this situation is that these households, the thresholds for individual households hasn't been adjusted for inflation, right? Since they were established decades ago. So this means more and more retirees are finding themselves subject to this tax as time goes on, effectively creating a stealth tax increase on seniors living on fixed incomes. Now, when we look at historical precedent, tax policy tends to evolve gradually rather than dramatically, especially regarding retirement benefits. So the current administration, like previous ones, recognizes the political sensitivity around senior benefits. So no, I don't think the administration is going to tinker with the taxation on that. I doubt that they will, but I also doubt that it's going to get any better. So either way, Jonathan, you're going to want to plan for when to take Social Security and how to do it in the most tax-effective way. This might involve coordinating your Social Security claiming strategy with your overall retirement income plan, potentially using Roth conversions or other tax planning techniques to minimize your provisional income in key years. Jonathan, thanks for that awesome question. And if you would like to send in a question like Jonathan did, you can do so by emailing them to poolelock@poolelocke.com. Let's get on to our second question, and this is from Rose. She says, I'm really worried about paying a premium on Medicare if I have a higher income in retirement. How can I avoid this? Okay, Rose, that's a beautiful name. That's my daughter's name. I love it. So, Rose, I think what you're talking about is really Great Aunt Irma, right? We have Great Uncle Sam, right? Who's not really our great uncle. He just takes money from us. And then Great Aunt Irma, that also takes money from us. And what IRMAA stands for, it's an acronym, of course, And it stands for income-related monthly adjustment. And essentially what happens is, I think you might be aware, Rose, is that your income, when it gets over a certain threshold, the cost for your Medicare Part B and Part D starts to increase. And it could be significant. It could be several $100s a month for single taxpayers. That increase starts at $106,000 of income. And again, they're using that modified income that we talk about when calculating taxes on Social Security. And also, the same thing is true with married couples, only it's double that, right? It's $212,000 of income. So here's how I kind of like to look at it. Let's say, Rose, you're single, right? If your income is $200,000 a year, well, you're far enough over the limit, then who cares, right? You have to pay a little bit more every month. But the problem is when you start to get in, and maybe you're at $120,000, people say, well, gosh, if I could just stay under the 106, then I don't have to pay that extra tax. Now, what's particularly frustrating about this IRMAA surcharge is that they work in brackets or cliffs, really. It's like a waterfall, a threshold, right? This means if you're $1 over a threshold, you could suddenly owe hundreds more in Medicare premiums annually. It's not a gradual increase like our regular tax system, which makes planning around these thresholds even more important for retirees on a fixed income. So again, another reason to plan accordingly is because of IRMAA taxation. Now when you start and say, gee, what makes the most sense for taking Social Security? For me, should I take it early? Should I take it late? Based upon a whole bunch of factors, your health, longevity of your family, whether you're married to someone younger, older, that person's health, that person's longevity. When you start to look at all of those factors and, then you decide when to take Social Security, then you've got to figure out, okay, how much, your required minimum distribution is likely and when that's likely to be starting. It starts at age 73 now, along with how much income you need earlier in your retirement, assuming you retire before age 73, and then start to piece that puzzle together and look at that provisional income calculation and determine how it affects your Social Security and determine how it affects IRMAA. Now, determining how it kind of the increased premium in Medicare Part B and D, right? So one strategy can be particularly effective, and that's strategically using Roth conversions in lower income years before you reach that RMD age of 73. Now, by shifting some of your traditional IRA assets to Roth accounts, you're essentially prepaying taxes at potentially lower rates now to avoid higher income and the IRMAA surcharge later when RMDs kick in. Now remember that Roth distributions don't count towards your IRMAA calculation, giving you more flexibility in managing your retirement income streams. Rose, thanks for an awesome question. And if you would like to send in your question like Rose did or Jonathan did, you can email them to us. You can email it to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.